Okay, market-based valuation. Kind of have to teach this. I hate teaching this. You know, we spend most of our month talking about real, scientific ways of approaching it, and then we have to do market-based, which is less scientific. But the bottom line is, it's used. It's real world. I will kind of summarize the chapter somewhat quickly, and then we'll go through it. My brain works in matrices, so what the chapter is really doing, at least for 4 of the ratios that we analyze, you have a value to book value ratio, value to book value, and this is the value that we've learned how to calculate in chapters 11 through 13 in some form, and comparing that to the book value. You have price compared to book value, and that's the market price or the market value, which is price times number of shares, value of equity. So, and when you think about it, price is the collective wisdom of the value, right? The market price is what the marketplace says the company is worth. You're all doing it through FSAP or whatever valuation techniques you learn. But the market price is simply the collective wisdom of everyone who's choosing to invest. And it's changing constantly in trying to find the right point. That's what the stock market does. It's looking for that equilibrium point. And as any little piece of information comes out, the Fed is changing interest rates. The company had bad earnings. There's a war in Afghanistan. Whatever little pieces of information are out there, some directly related, some not, the market is reconfiguring what it believes value should be. And so you have 2 different ways of looking at value. Our forecasted way and the market way. And then there are 2 different ways of looking at kind of accounting value. The book value from the balance sheet or earnings reports. And probably the most famous of all these ways of doing things is price to per earning, right there. That's your price per earning ratio. Now we'll talk about these value per earning and value, book value, and market value, book value. These are only really relevant in this form because we've done the work on value already, right? They're relevant in this form to compare to this form. So if you look at value per earnings, calculate value per earnings, and compare it to the price per earnings, and if your value per earnings is higher than the price per earnings, buy, right? So this is the kind of the summary of what I'm about to talk about. That's a terrible magic mark. Well, somehow or another. You've seen this chart before? In your evaluation? I don't know where that went. We will go through market to book, value to book, market to book, value to book, PE, and B. Okay, those are the 4. And then this newfangled thing, price with growth ratio, kind of hangs off at the end. So it's what I just said here. The market price, whether it's in the form of total value that the market ascribes to a company, or the specific price of a share of stock, is the aggregated expectations of a scientific and non-scientific set of buyers who are together finding that equilibrium point that between supply and demand that says this is what the company is worth. That's what the stock market does. Searches for equilibrium. All of these ratios have meaning because of their comparison with something. Price to earnings ratio, a common ratio, right? Stock price over the earnings per share. Should it be high or should it be low? What do you think? Do you want a high PE ratio? What's that? Whoa, you personally, would you look for a high PE ratio?
Do you mean if I was going to buy?
If you're going to buy?
Low.
You look for a low. Why?
Well, assuming the growth is properly related to the price, it's calculated like a price to earnings to growth ratio, but I look for something that's valued at or priced at a lower multiple of its earnings so that I could profit from the gain.
So you're looking for a PE ratio that's low compared to its historic value? Maybe. That makes some sense. Although the price might be reflecting the market's new reality that says, you know what, it's just not going to grow that much going forward. You don't really know. Right?
Wouldn't you want it to be less than like the value to earnings ratio?
That's where yes. So you want to look at it within a context.
Yeah.
You want to see it in a context. And I think you've mentally put it into context. It's low compared to your expectations of what it should be. Of course, you can have a very high price to earnings ratio, which bodes well for a company. Hey, the market's saying it's worth a lot, but it could be because your earnings were really bad. That's the denominator of your ratio. You know, you could be close to zero or negative earnings, and who knows what's going to happen there. So there is no right price to earnings ratio. All it is a number that in the context of other numbers, industry averages, historical levels, other ratios, gives you a clue. All of these ratios are based upon some market multiplier. And what they do is they provide a shortcut for valuation. A shortcut. Let's look at each of them. The market to book ratio. It's the market value of shareholders' equity over the book value of shareholders' equity. Two numbers that are relatively easy to find. Market value is just share price times the number of shares. Book value of shareholders' equity comes directly off the balance sheet. By itself doesn't tell you a whole lot. What might be useful, that's the market value to book value when compared to the value to book value ratio. The value to book value ratio, I'm not going to go through all of this because we've done it. Just takes the valuation models that we know and love. And what you're really going to do is if you compare your value to book value versus the market value, if your number is higher than the market value, that's a signal. Notice that the value to book value ratio starts at the number 1. Right? It's 1 plus something. And all this is it just took our valuation model and divided it by the book value. So it took our valuation model for the residual income, the one we just did this morning, and divides it by book value, and this is the result of that division. So it's in another word, it starts at 1. Value is equal to book value. Value is equal to book value at 1, plus residual earnings, discounted back. If you have non-economic earnings, earnings above or below what's expected, you're either adding value or taking value away from a company. And that's what that says. Starts that there is no expectation of earnings, and then it goes from there. Okay? And then it also has a continuing value, as we know, for year 6, perpetual, discounted back. I don't need to tell you how to do it. You can do this, do the mid-year adjustment, etc. So if it's equal to 1, then your value is equal to your book value. And as I said, the value differs from book value based upon your ability to create value through your operations. This just says you create value if your return on shareholder equity is greater than your required rate of return. You remove value if it's less than it. And if the only thing that changes is your risk profile, you take on more debt, you change your leverage, you take on a new business line, whatever it is, if your risk changes, that will effectively change your required rate of return. And that will either add or decrease value in that way. So if you take on more risk, but you don't improve your return on shareholder equity, then you reduce your wealth. Because risk without commensurate reward is not worth it. Of course, we're dealing with book value. So at any point in time, things could be out of whack. We'll talk about R&D as an example. If you buy R&D, it helps your book value. If you invest in R&D, it hurts your book value. Right? If you buy it, you have your intangibles go up, and therefore your shareholders' equity. If you generate it internally, it's just an expense, which reduces your return until it starts to generate income. So there's a lag effect with R&D on the books. In theory, you might be doing a lot of R&D. Some of it clicks and some of it doesn't. In theory, over time, it's going to click. Otherwise, you're probably in the wrong line of business. So over the long haul, it'll all come together. In the early years, your internally developed R&D expenses will not have any income coming with it, so your return on shareholders' equity will be low. Later on in your life cycle, you're not investing in R&D anymore, so you'll have lots of income without the costs. So over the long haul, this works itself out. But at any given point in time, it may not quite be right. I'm not going to go through this in great detail, except to show that Pepsi, based upon this, Pepsi creating a discount. I'm not going to go through. So that was the value to book ratio. Now let's look at some of these earnings ratios. We did the book ratios. Value to earnings. again, in and of itself, it doesn't do much for us. It's only good because we're going to compare it to the price to earnings, which is commonly reported and therefore a useful number to compare to. Value at point 0 is the present value of our future income. You know how to do that? At year 0. Compare that to your earnings in year 1, your next year's earnings. That's what you want to try to do. And you could do it as total market value or per share. That's just mathematics. Your PE ratio. It's your current share price divided by your reported earnings per share. We know it's frequently quoted. And as we talked about, it has to be compared to something to be useful. It's somewhat problematic to use. The current share price, the price that the market says you're worth, is looking forward, right? The market's always looking forward. How much are you going to be worth in the future? That's Apple's big question these days. You know, Apple's trying to find its new equilibrium. Post Steve Jobs, is it going to have the amazing growth it's had in the past or not? We don't really know. Different people in the markets have different perspectives. The earnings per share might have unusual or non-recurring items. Quite often, analysts in the marketplace will take those out. You'll hear them reported with or without one-time charges. But there's also the earnings per share, the price to PE ratio has an inherent time misalignment. Because at the point they're reported, the price is reflecting the future, and the earnings is reflecting the past, right? PDE is usually using the last quarter, the last year, whatever you want for earnings. So you have a price that's looking forward and earnings that are looking backwards. Now, when you compare the value earnings ratio with the price earnings ratio, you could recalculate PE to look forward. You could recalculate VE to look back on earnings, so you can get them aligned to each other. You want to compare them apples to apples. You don't normally see people taking the price divided by next year's earnings, or next quarter's earnings. It's what the market is doing reporting last quarter's earnings. In an ideal world, once you get the apples to apples comparison going, the PE and the VE ratios should equal each other, meaning the market has figured out the value. And with that, I think the book goes through this derivation. We won't. In that situation where PE is equal to VE, the PE will be equal to 1 over the required rate of return. And essentially it's saying you're not expecting non-economic income in the future. You're not expecting residual income in the future beyond what the market already says. This is a relatively low P. This is the lowest P that's reasonable. So if your PE is trading there, you should have an expectation it should rise from there.
Sorry, whose discount rate is that?
Sorry.
Whose discount rate is that?
It's the company's discount rate.
Oh, because it's a threshold.
Yeah. On equity, not on, not weighted average. Okay, so what do we think about the PE ratio? It's a ballpark estimate for valuing as a multiple of earnings. That's good. You should be benchmarking it versus the industry average, if you can find that, versus other companies, versus previous results of your company. It's used to establish a price for an IPO. So it can be done like the morning of to establish that price. You kind of know the price, but when they do an IPO, the price is defined the morning of, and so you can wait for the very last minute. It provides speed and efficiency traded off with precision. So, in the market, speed and efficiency wins. You want to be the first to know something. Yes, sir.
The PE we said is established to price an IPO. Is that because IPO is not exposed to the market before that? So you kind of have the value and the market price the same? Is that as why?
It's because you're right. If it's a new issue, it's not exposed to the market before that. So, but it's because when you're pricing an IPO, you're trying to find the appropriate. The investment bankers are trying to find the appropriate equilibrium point upon which the stock can grow.
Yeah, basically like an average, like where they should go, at what price they should put it in. It's probably not the exact.
It's not going to be the exact. I mean, it's a totally different class, but generally speaking, an investment banker, if they're doing their job right, is going to price a stock below what the market really wants for that stock to give that stock a chance to grow in its first few days. Think of Facebook. Facebook was priced too high, and the market collapsed on it. Then it found its equilibrium over time, but it got a lot of bad press in the interim. And it was priced too high, frankly, because the market priced it too high. All of us idiots who said, "Oh, it's Facebook, it's going to make gazillions," wanted a piece of the action, and that created an artificial supply and demand situation.
I heard an acronym for IPO saying that it's probably overpriced.
It's probably overpriced. I don't know. I would suggest that over the long haul, that's not true.
Long haul.
Over the long haul, for any given stock, it's possibly true. But over the long haul, an investment banker doing their job wants to create the correct market momentum for a stock. And if you overprice it, that doesn't create the proper.
And if the company's strategies, work out, then of course it should have that growth. But just when it first comes to market, the people who owned it when it was private kind of looked to cash out, because if they felt it was still profitable in a small scale, they may just continue to keep it private. There's a balance of what actually takes place.
Well, you cash out for the same reason anyone else would cash out, and you have $1 billion tied up in the value of something that you can't get at. You have an IPO, and it gives you a chance to get at some of that $1 billion.
But my point is that if you know that for sure it's going to make $1 billion, you might keep all the money for yourself and kind of just keep the company private. So there's also a balance when it comes public. Is it worth it or not? And that's why I just made that joke.
We could have a separate class for that. If you guys want to come a week from Monday, I may or may not be here. But it's a interesting conversation.
I was working at Morgan Stanley when we did the IPO on Facebook.
Oh, is that right?
Yeah.
Is that your fault?
No. My clients were relatively new to me, so I wasn't able to allow them, and you had to have some seniority,
Right.
but
Right.
I did work on some of it.
Interesting. Okay, so PE ratios, or the middle 50% ratio. I think I lost the right-hand side of this slide. Okay. You can see the middle 50%, kind of like an SAT score by industry for PE ratios, and it has to do with the very, it'll closely relate to data when you get down to it, the relative risk that you'd expect. But that's the required rate of return to be collected. But you can see that they're somewhere between, let's say, 10 and 25. I guess a little higher for some of these high data type of industries. Okay, capital market efficiency. So earnings are reported. Anyone track a stock right after earnings are reported? It's an opportunity. As soon as earnings are reported, markets are generally efficient, and not perfectly efficient by any stretch. They're getting more and more efficient over time as information becomes more and more available. So markets are totally efficient when there's 100% of information available to everybody. We'll never get there, but we move in that direction. So earnings information is released by a company. The analysts scurry to understand what it means, and then there's a flurry of buying and selling based upon whether they met earnings estimates or didn't meet earnings estimates, etc. So what happens is the market fluctuates a lot right after earnings. And if you're insightful about that point in time, for those of you who are searching for alpha, anyone knows what alpha is?
Seeking Alpha, the website?
Seeking alpha is, alpha is the ability to consistently do better than the market. When I've taught a finance class, I challenge my class. We have a little market game that there are a lot of market watch or whatever, and I gave the class like $10,000 to invest, and all I would do is invest in the S&P 500, and they can invest in anything they want. And in a class of 30, maybe 4 can beat the S&P 500.
It's better than mutual funds.
I played that game in high school, actually.
And how did you do?
I did really well, actually. I was excited in class.
And did you beat 500?
We didn't play it with the 500. She just gave us like money to invest, and then it was just like over the market period. We were just supposed to like play with it and then see how it came out.
It's fun.
Yeah, it was fun actually.
Other people's money. So. But anyway, this is how markets react. In a completely efficient market, this is the point of the earnings announcement. It finds its new level, either above or below. This is just saying above. And then it's, at that moment in time, it will just trade at that new market price. One of two things generally happens. Either there's an overreaction to positive news, and it goes up above where it should, and then has to find its way back to its new appropriate level. Or the market is less than excited about the news, and it delays its reaction to find the new level. So this is a period where you can do well vis-a-vis the market. If you have a conviction, it's about a conviction. What should the new price be? And as the market's seesawing trying to find it, you invest for that new price. Okay, the last thing we'll talk about is the price with growth approach, the fifth ratio. And all it says is you look at the required rate of return and the long-term growth rate, this perpetuity factor that we've been working with, and just 1 over that number is a ratio. That essentially says your shareholders require a rate above the perceived long-term growth rate. And that's a ratio by itself. It's kind of like the PE ratio, but it doesn't do your first 5 years forecasting. It's just kind of looking past that. So that's that. Okay, that's it.